You think you're rational, but you're not. The moment you sit in front of the market, your brain begins a quiet sabotage. Montier starts with the blunt truth. You are biologically and psychologically wired to fail at investing. Overconfidence, loss aversion, confirmation bias, they're not quirks. They're your default settings. And if you don't confront them, they will quietly drain your account. You've probably felt it before. That rush of certainty before a trade, the impulse to hold on to a loser, the satisfaction of finding an article that confirms your thesis. These are not signals of wisdom. They're symptoms of bias. And Montier doesn't sugarcoat it. Unless you actively fight back, your brain will betray you. Let's start with overconfidence. You think you know more than you do. You believe your intuition is sharper than it actually is. In study after study, individuals rate their own abilities far above average. Traders, even worse. The more you trade, the more convinced you become that you're right. That's not insight. That's ego wrapped in cognitive bias, and it kills performance. Then there's loss aversion. This one's brutal. Montier cites Kahneman and Tversky's work. People feel the pain of a loss twice as much as the pleasure of a gain. So what do? You cut your winners too early, afraid they'll reverse, and you hold your losers too long, refusing to accept pain. It'll come back, you whisper. But that's not logic. It's your brain clinging to hope over math. Confirmation bias is the next trap. Once you form a belief, say that Tesla will soar, you seek out evidence that supports it. You ignore bearish arguments. You block out risk. You build a bubble. And inside that bubble, the truth gets warped. You don't trade what's in front of you. You trade your story. Montier shows how these biases are hardwired. They come from our evolutionary history. Overconfidence helped early humans take risks. Loss aversion kept us alive. Confirmation bias preserved group cohesion. But in the modern market, these instincts are liabilities. So what can you do? First, admit you're not immune. The moment you say, "This doesn't apply to me," you've already fallen victim. Montier's message is clear. Awareness is the beginning of control. You can't delete bias, but you can build systems that minimize its influence. One strategy? Pre-mortem thinking. Before you enter a trade, ask, if this goes wrong, what likely caused it? This forces you to consider alternative views. It breaks the spell of certainty. It injects humility into your process. Another? Use checklists. Pilots and surgeons use them. Why not traders? A good checklist doesn't just guide your setup, it guards your psychology. It reminds you to question your assumptions, to define your risk, to check your ego at the door. Montier even recommends slowing down your thinking. Fast decisions feel good, but they're usually reactive, emotional. System 1. You want System 2, deliberate, reflective, analytical. Take a breath, reread your thesis, play devil's advocate. These micro habits build resilience against mental shortcuts. And yes, it takes effort. You'll feel resistance. Your brain wants to trust its gut, but that's exactly why most traders fail, because they think they're being logical, when in fact, they're just being human. You're not trying to become emotionless. You're trying to become aware. You're not trying to be perfect. You're trying to be prepared. Because the market doesn't punish your plan. It punishes your blind spots. Montier opens the book with this foundational wake-up call. If you don't understand how your brain distorts your view, you have no edge. None. So before you chase setups or tweak strategies, look inward. Your real opponent isn't the market. It's your own mind. And that's where this journey begins. You've had a hot streak, and now you think you've cracked the code. But what if those wins were just luck? Montier breaks down how randomness masquerades as skill, leading you to double down on bad habits you think are edge. It's one of the most dangerous illusions in trading, thinking success equals skill. You nail 3 trades in a row. You feel unstoppable. Your confidence soars, and without realizing it, you start changing the rules. You take more size. You skip the checklist. You act fast instead of thinking deep. You believe you've evolved. But what if that streak was pure chance? Montier cites endless research proving that most short-term outperformance is indistinguishable from randomness. Think of flipping a coin. Some people will get heads 5 times in a row. That doesn't make them talented. It makes them lucky. But the mind hates randomness. It craves cause and effect, so it rewrites the story. I'm improving. You tell yourself, my edge is stronger. In truth, you might just be reinforcing behaviors that have no statistical basis. You're not compounding skill, you're compounding delusion. This is how traders fall into the trap of illusion of control. They mistake favorable outcomes for good decisions. But as Montier insists, good outcomes do not always come from good process, and bad outcomes do not always mean bad decisions. It's about probabilities, not absolutes. Let's break it down. Say you take a setup outside your rules and it wins. Your brain logs that as evidence. Maybe I don't need to be so strict. Next time you stretch even further. You size up. You act impulsively. And if luck smiles again, the behavior becomes a habit. That's not strategy. It's survivorship bias. Montier points to a stunning statistic. Professional fund managers who outperform over a 5-year stretch often underperform the next 5. Why? Because markets revert, luck runs out, and skill without discipline gets exposed. So how do you protect yourself? First, decouple outcomes from process. Don't judge your execution by whether you made or lost money. Judge it by whether you followed your system. If you broke your rules and won, you didn't win. You got lucky, and you taught yourself the wrong lesson. Second, track everything. Montier is relentless about measurement. Log your trades, record the reasoning, note your confidence level before the outcome is known. Then review. Look for patterns. Are your biggest wins coming from setups you normally avoid? Are your most consistent profits tied to disciplined entries? This is how you separate edge from noise. Third, use statistical validation. Don't rely on memory. Don't rely on gut feel. Backtest your ideas. Simulate your strategy. If it doesn't hold up across hundreds of trades, it's not an edge. It's an anecdote. Montier quotes the legendary trader Ed Seykota. Win or lose, everybody gets what they want from the market. And often, what you want is confirmation. You want to feel good. You want to be right. But markets don't care about your feelings. They care about math. They care about risk. This is why Montier urges traders to become probabilistic thinkers. You're not trying to predict outcomes. You're trying to manage a process where good decisions stack over time, even if they lose short term. This is hard. Your ego wants validation now, but the most successful traders detach. They treat trading like poker. One hand means nothing. 100 hands reveal everything. You must become a collector of small, repeatable edges, not a chaser of big, emotional wins. And if your streak ends, and it will, don't panic. Don't scramble to get it back. Review your journal. Check your process. Ask, was I lucky or was I sharp? Because the answer to that question will shape your next 1,000 trades. Montier's warning is simple but profound. Most people overestimate skill and underestimate luck. Don't be most people, because if you confuse the two, you'll build a strategy on sand, and when the tide turns, you'll drown in your own confidence. You buy the top because it feels safe. Montier explains how herding behavior and performance chasing infect your psychology, driving you to follow the crowd, right off a cliff. You've done it. You saw a stock break out on volume. Everyone on Twitter was cheering. You didn't plan to trade it, but suddenly you felt left out. I'll just catch a quick move, you told yourself. You hit buy. Minutes later, it reversed. And now you're stuck. That's herding behavior in real time. Montier dedicates this section to one of the most destructive biases in investing, the human need to conform. We're social animals. Following the crowd makes us feel safe. In prehistoric times, that instinct kept us alive. Alone meant danger. Together meant survival. But in the market, that instinct is a trap. When everyone's piling into the same name, the move feels validated. You don't just see price action, you see acceptance. You think they can't all be wrong. But Montier reminds us, they often are. In fact, the crowd is usually wrong at extremes. Tops are formed when optimism is highest, bottoms when fear is deepest, and by the time the crowd notices a move, it's usually over. Performance chasing is the next step in the spiral. You see a fund, a trader, or a stock with impressive recent gains. You don't ask why it's up. You just want in. It's working, you think. I'll ride the wave. But that wave is already cresting. Montier points to a mountain of research showing how investors consistently pour money into top-performing funds after the run has peaked. The result? Subpar returns, regret, and reactivity. He calls it the behavior gap, the difference between investment returns and investor returns. The market might rise 8%, but the average investor only makes 4 cents because they chase heat and flee during drawdowns. You think you're optimizing, but you're just following. So why does it happen? Because safety feels good. When everyone's doing the same thing, you don't feel alone. You feel justified. But that's a false comfort. Montier shows how professional money managers do the same. They hug benchmarks. They crowd into consensus trades. Why? Because if they're wrong while everyone else is wrong, they won't get blamed. Being wrong alone is career suicide. But being wrong together, that's survivable. Now ask yourself, are you trading to win or trading to feel comfortable? Montier offers strategies to counter this bias. First, flip your focus. Instead of asking what's working now, ask what's overowned now. Instead of chasing, you start positioning. That requires discipline, patience, and a willingness to be early. Second, build systems, rules, watch lists, filters that screen for setups, not noise. The crowd reacts, but your edge is preparation. If you find yourself jumping into a move because it feels urgent, that's not your setup talking. That's your insecurity. Third, make peace with isolation. Great trades often feel lonely. When you buy fear and sell greed, you'll look crazy for a while, but those are the trades that pay. Montier emphasizes alpha is earned by being different and being right. Being different alone isn't enough, but if you're following everyone else, by definition, you have no edge. This is why conviction matters. You need a thesis grounded in data, in process, not in emotion, because when the crowd moves, they move fast, and if you're just tagging along, you'll be the last one in and the first one out at a loss. Montier also suggests journaling emotional triggers. What makes you want to chase? Is it envy, boredom, fear of missing out? Get specific, because clarity creates control. If you know your triggers, you can pause before acting. And finally, zoom out. One trade won't change your life, but a consistent pattern of reactive trading, that will erode your account. Step back. Ask, am I following a process or a panic? The truth is, the crowd will always tempt you, but your job is to trade despite them, not because of them, because the top feels safe until it isn't. You'll risk everything to avoid a loss. Montier reveals how loss aversion warps your thinking, causing you to hold losers, sell winners, and sabotage long-term returns in the name of short-term comfort. You've probably said it, it's not a loss until I sell. But deep down, you know that's a lie. You're not waiting because the trade still makes sense. You're holding because accepting the loss feels like failure. It's emotional. It's painful, and it's universal. Montier brings the data. We're biologically hardwired to hate losing. According to Kahneman and Tversky's prospect theory, the pain of loss is twice as powerful as the joy of an equivalent gain. Lose $100, and you'll need a $200 gain just to emotionally recover. That's not logic, it's a survival instinct. But in markets, that instinct turns toxic. Here's how. First, you cut winners too soon. The moment you're green, you get nervous. You imagine giving it back. Let me take the profit now, just in case. But by doing that, you limit your upside. You let fear make the decision, not your strategy. And Montier shows how this ruins compounding. Big winners are rare, but if you keep selling them prematurely, you'll never see one fully develop. Second, you hold losers too long. You enter a trade, it drops, your stop is hit, but you move it. It's oversold, you say. It'll bounce. But it doesn't. Now it's down more. You don't want to take the loss. You want to avoid the pain. So you freeze. And that inaction compounds into catastrophe. Montier's data shows how investors consistently underperform their own holdings because they make these emotional decisions at exactly the wrong time. Loss aversion also leads to the disposition effect, a behavioral bias where traders are more likely to sell winners and hold losers. Why? Because taking a win feels like closure. Taking a loss feels like punishment, so you keep your pain on the books, hoping it will disappear. Spoiler, it doesn't. Montier pulls no punches here. He says, most investors would rather be wrong than realize they were wrong. And that distinction matters. Being wrong is inevitable, but staying wrong? That's a choice, a costly one. So how do you fight this? First, predefine your exit before entry. If your stop is 50 below entry, honor it. Make it mechanical. Remove the emotion. Don't negotiate with your brain mid-trade. That's when bias takes over. Second, use mental accounting to your advantage. Montier suggests treating each trade like a separate investment. Don't think about what you've made or lost this week. Think about this trade. Does it still fit your plan? Would you enter it now? If not, get out. Third, flip the script. When a trade goes against you, view the stop as strength, not failure. You're protecting your capital. Preserving mental energy. Maintaining objectivity. That's not weakness. That's professionalism. Fourth, journal the pain. Every time you hold a loser or cut a winner, write down how it felt. What did you fear? What did you hope for? Over time, this awareness rewires your reactions. You become more honest, more detached. Montier also recommends reframing losses. Instead of seeing them as negative, see them as tuition. The market charges fees for education. You can't avoid them. But you can choose whether you learn or repeat. And here's the key. Losses are part of the game. If you trade scared of losing, you'll never take real trades. But if you build a framework that respects risk, you free yourself to execute cleanly without emotional interference. Loss aversion won't disappear. It's hardwired, but it can be managed. And that management creates a gap, a space between stimulus and response. That space is where your edge lives. So the next time you hesitate to take a loss, ask yourself, am I protecting my account or my ego? One helps you grow. The other keeps you stuck. You think in stories, not statistics. Montier explains how narrative fallacy makes you believe you understand the market, when really you're just crafting feel-good fiction to explain randomness. Your brain craves meaning. You want to know why something happened. You want the reason the market dropped, the why behind a breakout. So you string facts together. You craft a story, and it feels good because it gives the illusion of control. But as Montier explains, that story is almost always fiction. He calls it narrative fallacy, the tendency to build a coherent explanation from disconnected events. You create links between cause and effect that aren't supported by data. The Fed caused this rally. The CEO's tweet triggered the breakout. Maybe, but maybe not. Often, markets move for reasons no one understands in real time. But here's the trap. Once you believe the story, it feels like truth. You act on it. You double down. You ignore evidence that contradicts it. And suddenly, you're not trading a chart. You're trading a fantasy. Montier gives the example of analysts explaining market movements after the fact. One day, the market is up because of strong jobs data. The next day, it's down because of the same data. The facts didn't change. The story did. That's the danger. We explain first, analyze later. This bias is especially harmful for traders because it makes you believe you understand the market. And the moment you believe you understand, certainty creeps in. That's when risk management fades. That's when you stop asking, what if I'm wrong? You start thinking in absolutes. It has to bounce here. This breakout will continue. But the market owes you nothing. It doesn't care about your story. It only respects your discipline. Montier urges you to think in probabilities, not narratives. The story doesn't matter. The setup does. The edge does. The risk does. Everything else is noise. So how do you counter the narrative trap? First, acknowledge randomness. Most outcomes in the market are multifactorial. You don't need to know why a stock moved. You only need to know if the conditions were right to take a trade. Second, build a system that ignores the story. Structure your trades around clear setups with objective criteria. Entry, stop, target defined in advance. When those boxes are ticked, you trade. When they're not, you don't. That removes the need for explanation. Third, question your assumptions. When you feel certain, pause. Ask, what else could be true? Train your brain to entertain alternative scenarios. This breaks the narrative trance and opens space for flexibility. Fourth, detach from the news cycle. Montier highlights how media thrives on storytelling. Stocks rally on optimism. Markets fall amid fears. These are not actionable insights. They're emotional clickbait. You don't need to understand the headline. You need to understand your risk. Fifth, journal your trades by logic, not outcome. After every session, write what the setup was, why you took it, what you were thinking, not what the market did. Over time, this builds a catalog of process-based thinking rather than result-based rationalizing. Montier shares a haunting truth. Some of the worst investors are the most articulate. They can explain everything. They sound smart. They build dazzling stories. But they ignore the data, the structure, the probabilities. And that brilliance becomes a trap. Because clarity doesn't come from storytelling. It comes from simplicity. And if you want to be consistent, you have to train your mind to prefer rules over reasons. Trade your plan, not your opinion. Respect your stops, not your story. Measure your performance, not your predictions. That's how professionals think. You're not here to make sense of the market. You're here to navigate it. You think you're improving, but you're just staying busy. Montier explores why trading too often feels productive, but is usually a dopamine trap fueled by illusion of control and emotional highs. You know the feeling. You've just closed a trade, maybe even 3. You're watching the tape tick, charts flash across your screen. You're scanning, clicking, reacting. You feel engaged. You feel alive. But here's the truth Montier throws at you. Most of that activity? It's noise, motion without meaning, and worse, it's addictive. Montier reveals a harsh reality. The market is a casino, and you're not immune to its reinforcement loops. Every trade is a dopamine trigger, a hit of stimulation, a rush of control. Even losing trades keep you engaged, because being active feels like being competent. But this is a lie. Your brain mistakes activity for progress. You equate more trades with more growth. But the data says otherwise. Montier cites study after study showing that the more you trade, the worse your returns. Hyperactive investors underperform consistently. Why? Because they're not optimizing. They're scratching an itch. It's called the illusion of control. You think that by trading more, you're mastering the market. But in reality, you're just reacting. Impulsively, emotionally. You see a candle break a level and feel compelled to act. You're not following your edge. You're following a craving. Montier compares it to gambling addiction. The lights, the feedback, the anticipation, it hijacks your reward system. Trading platforms are designed the same way. Instant fills, color-coded P&L, alerts. All of it feeds a loop that feels like skill, but is powered by biology. Here's how to know you're stuck in the trap. You feel anxious when you're not in a trade. You enter setups you wouldn't normally take just to stay active. You overtrade after a win to press the advantage. You revenge trade after a loss to get it back. You ignore your journal, but never miss a chart scan. Montier emphasizes this isn't discipline. It's compulsion. And the consequences are brutal. Every unnecessary trade exposes you to risk. Every impulsive click chips away at your edge. Worse, it reinforces bad behavior. You might get lucky. That scalp might work. But instead of learning from the mistake, you reward it. So what's the antidote? First, limit your trades. Set a cap per day. If you hit your limit, walk away. This forces selectivity. It breaks the link between emotion and execution. Second, build pre-trade checklists, not just technical, emotional. Ask, am I bored? Am I reacting? Am I clear? If the answer is no, don't trade. Third, log emotional states. Montier suggests tracking how you feel before each entry. Over time, patterns emerge. You'll see that most impulsive trades follow a loss or come late in the session. That data becomes your defense. Fourth, schedule inactivity. Create specific hours where you observe, but don't trade. This rewires your brain to detach attention from action. You learn that presence doesn't require performance. Fifth, celebrate inaction. When you skip a setup that didn't meet your criteria and it loses, write it down. That's execution discipline. That's restraint, and it deserves just as much recognition as a green trade. Montier also encourages traders to reflect weekly, not just on outcomes, but on activity levels. Were you active because the market presented clean opportunities, or because you needed to feel busy? This brutal honesty is rare, but transformative. Because trading is like chess, not boxing. You don't win by throwing more punches. You win by seeing more clearly and acting only when the position demands it. Montier says it best, don't confuse action with achievement. Real traders aren't trying to be active. They're trying to be effective. So the next time you feel the urge to click, pause. Ask, is this my system or my craving? Because if you want to trade for a living, you need more than charts. You need control over your need to control. You try to predict the future, but you can't. Montier dismantles the forecasting myth and shows why focusing on process and risk is the only rational response to uncertainty. Let's get this straight. You're not a fortune teller. You're not meant to know where the market is going next. And the moment you start pretending otherwise, you begin trading a fantasy, not a strategy. Montier holds nothing back here. Forecasting is an illusion, and chasing it is one of the most expensive mistakes you can make. He opens with brutal research. Economists, analysts, strategists, none of them consistently predict future outcomes better than chance. Montier references studies where expert predictions about interest rates, GDP, or market direction failed to outperform simple models or even random guesses. So if professionals with teams, tools, and decades of experience can't do it, why do you think you can? Because forecasting feels good. It gives you comfort, a sense of control. I know the Fed will pause. Earnings will beat. This stock has to rally after that breakout. You build a narrative, anchor to it, and ignore everything else. But that comfort is expensive because when your identity is tied to your forecast, you fight the market instead of responding to it. Montier explains that forecasts are false precision. They make you feel smart. They allow you to sound confident, but they're guesses dressed in numbers. And the danger isn't just being wrong, it's being blinded. You stop seeing risk, you dismiss opposing evidence, and you stick with trades that no longer make sense, all to protect your ego. You've seen it in your own trading. You call a breakout, it fakes out. But instead of exiting, you double down, you hold, you justify. The fundamentals are strong. It's just shaking out weak hands. But the truth is, you didn't want to admit you were wrong. That's not process. That's pride. So what's the alternative? Montier points to one word: process. You don't predict. You prepare. You build a system that works across conditions. You define your edge. You manage your risk. And you accept that you'll never know what happens next. That's not weakness. That's professionalism. Here's how to reframe your thinking. First, ditch predictions. Replace "this will happen" with "if X happens, I'll do Y." Conditional logic keeps you agile. Forecasts trap you. Plans free you. Second, focus on risk, not reward. Montier emphasizes your job isn't to chase outcomes, it's to survive. That means respecting stops. That means position sizing. That means always asking, what if I'm wrong? Third, think in probabilities, not absolutes. No setup is 100%. If you only take it when you're sure, you'll miss everything. The best trades often feel uncertain, but have clear structure. You trade the odds, not the feeling. Fourth, use scenario planning. Map multiple outcomes. What if the market breaks out and fails? What if volume dries up? What if a macro shock hits? Having these answers before you enter makes you adaptable during the trade. Montier even suggests rewording your journal. Instead of saying, "I predicted this move," write, "My plan aligned with this outcome." Language matters. It shapes identity. And you want your identity rooted in discipline, not clairvoyance. He quotes Howard Marks. You can't predict. You can prepare. That's your edge. That's your defense. Because when you stop chasing certainty, you free up energy for what actually matters: execution. Forecasting feeds the ego, feeds consistency. You can't know the future, but you can control how you show up for it. And that's enough. You follow experts because it feels safe. Montier shows how guru worship blinds your judgment, replacing personal responsibility with false confidence. It starts innocently. You follow a trader on social media. Watch a few interviews. Read a glowing newsletter. Their conviction is magnetic. Their track record sounds bulletproof. And you think they know what they're doing. So you borrow their trades, their opinions, their worldview. And for a while, it works until it doesn't. Montier calls this authority bias, the tendency to defer to experts even when their predictions are unsupported. Why? Because responsibility is heavy. Forecasting outcomes is hard. It's emotionally comforting to let someone else carry the weight. But here's what you don't see. The guru doesn't know you. Not your capital. Not your risk tolerance. Not your edge. And most importantly, not your exit plan. You're outsourcing your decisions to someone who won't share your consequences. That's not smart. It's reckless. Montier digs deep into the data. When researchers studied the forecasting ability of market gurus and high-profile strategists, the results were damning. Most experts performed no better than random chance. In many cases, their boldest calls were the most wrong. But they kept their followers. Why? Because humans crave certainty more than accuracy. You want to believe someone knows that there's a map, a shortcut, a key to the chaos. But Montier reminds you, there is no oracle. The market isn't a machine waiting to be decoded. It's a complex, adaptive system filled with randomness, reflexivity, and emotion. And even if the expert is right, what happens when they change their mind and don't tell you? What happens when their risk tolerance shifts? What if they scale out while you're still holding full size? You're left in the dark, reacting to someone else's incomplete plan. This is how traders get stuck. They stop thinking. They start following. They defend the guru's ideas like a tribe defends its leader. And in doing so, they lose the most important edge they ever had, their ability to adapt. Montier's solution? Reclaim responsibility. First, stop idolizing. No trader is infallible. Not Dalio, not Druckenmiller, not Buffett. Respect experience, but never confuse it with certainty. Every expert is guessing, just with more confidence. Second, use other opinions as inputs, not instructions. When you hear a thesis, don't accept it, test it, break it, ask, does this align with my process? If not, discard it. Third, build your own framework. Your trading plan should be independent, self-generated, rooted in your edge. If it can't stand without someone else's opinion holding it up, it's not a plan. Fourth, track borrowed trades. Montier suggests tagging any trade you took based on someone else's conviction. Review the results. Most traders find that these are their worst performers, not because the ideas were bad, but because the execution wasn't theirs. Fifth, take ownership, even when it hurts. If a trade goes against you, don't blame the newsletter. Don't say, but they said. Own it. The moment you clicked buy, it became yours. That accountability is painful, but it's the path to real growth. Montier isn't anti-learning. He's anti-blindness. Learn from others, study their frameworks, understand their logic, but never suspend your own judgment. The market is not a classroom. It's a mirror, and it reflects what you do, not what someone else said. Because when you stop thinking for yourself, you stop growing. And in trading, stagnation is just a slower form of failure. You hate ambiguity, so you reach for fake certainty. Montier explains how investors overpay for the illusion of safety, and how embracing uncertainty is the key to real edge. Let's face it, you want to know what's going to happen next. You want clarity, a clean forecast, a signal that doesn't waver. But markets don't work that way. They are uncertain by nature, and your need for certainty, if not managed, will cost you everything. Montier describes this as one of the most expensive psychological habits in investing. Paying for comfort, not value. Investors consistently overpay for assets they perceive as safer. Dividend stocks, blue chips, stable sectors. These attract flows not because they're mispriced, but because they offer emotional ease. That emotional premium distorts rational thinking. You've seen it yourself. You avoid volatile charts, even when they fit your edge. You cling to news headlines that offer a clear narrative. You buy into safe assets because the discomfort of uncertainty feels unbearable. But in doing so, you often sacrifice potential and ignore probabilities. Montier shares examples of investors paying a premium for earnings predictability, even when those stocks are overvalued. They're not chasing alpha, they're chasing certainty. And when that certainty breaks, because eventually it always does, the emotional fallout is huge. Why does this happen? Because your brain confuses uncertainty with risk. But they are not the same. Risk is measurable. It can be defined, calculated, and managed. Uncertainty, however, is unknowable. It makes you feel exposed, but it doesn't automatically mean danger. In fact, Montier argues the real danger is avoiding uncertainty. Because when you reject uncertainty, you reject the unknown, and the unknown is where all opportunity lives. If everything is priced in, where's the edge? Your advantage comes from being willing to act where others freeze. So how do you train yourself to tolerate ambiguity? First, shift your focus from prediction to preparation. You don't need to know what will happen. You need to know what you'll do if something happens. Create conditional plans. If price breaks X, I'll do Y. That gives structure without demanding false clarity. Second, use position sizing as a pressure valve. You don't need to go all in to explore uncertainty. You can test, scale, probe. When your size is aligned with your conviction, uncertainty becomes manageable. It becomes data, not dread. Third, journal your reactions to ambiguity. Montier suggests logging how you feel during uncertain markets. Do you panic, freeze, force trades? That awareness builds resilience. Over time, your emotional threshold increases. Fourth, expose yourself incrementally. Just like cold exposure builds physical tolerance, emotional exposure builds psychological endurance. Trade one volatile setup, hold one swing trade overnight. Let yourself sit with the not knowing. Then review what happened. you'll discover that most of the fear was imaginary. Montier's deeper point is this: uncertainty is not your enemy, it's the environment. Trying to eliminate it is like trying to remove wind from sailing. You don't resist it, you learn to navigate through it. And here's the kicker: the more you accept uncertainty, the less reactive you become. You stop forcing trades. You stop clinging to opinions. You start flowing with what the market gives you. And that flexibility, that psychological elasticity, is your real superpower. Because the trader who can stay calm when others panic, who can wait when others chase, who can adapt when others are paralyzed, that trader thrives. Montier leaves you with this truth: certainty is a feeling, not a fact. And feelings don't protect your capital. Discipline does. So train yourself to think in ranges, not targets. In scenarios, not absolutes. Let go of the myth that you'll ever figure it out. The goal isn't to conquer uncertainty. The goal is to function excellently within it. You know your mind is the enemy. Montier ends with tools to fight back: journaling, pre-mortems, checklists, and process discipline that keeps your brain from sabotaging your trades. After walking you through the entire cognitive minefield, Montier doesn't just leave you staring at the mess. He gives you the toolkit. Because now that you know how deeply flawed your natural decision-making is, the only way forward is with structure. Not more emotion. Not more opinions. More process. And it starts with journaling. You think you remember your trades, but you don't. Your memory lies. It deletes context, rewrites outcomes, and conveniently forgets your mental state. Montier insists, if you're not journaling, you're not learning. Every trade should be recorded, not just the entry and exit, but the reasoning, the emotion, the conditions, the level of confidence. Why? Because journaling turns abstract behavior into tangible data. It turns instinct into insight. Next comes the pre-mortem. Most traders only do post-mortems. Why did this fail? But by then, the damage is done. A pre-mortem flips the timeline. Before entering a trade, ask yourself, what could cause this to fail? This simple exercise forces objectivity. It invites doubt before you're emotionally invested. It's not negative thinking, it's risk preparedness. Montier loves checklists. And if you're serious, you should too. Think about it. Pilots use them. Surgeons use them. These are professionals who manage life or death decisions. And they don't trust memory. So why do you? A trading checklist keeps you honest. It ensures consistency. It blocks emotion from overriding protocol. Your checklist might include setup conditions, risk metrics, size confirmation, emotional state, and market context. Run it before every trade, no exceptions. Then comes the real battleground: discipline. Montier doesn't romanticize discipline. He treats it like a muscle, one you build, not one you're born with. That means rules, systems, limits, and most importantly, consequences. If you break a rule, don't just feel bad, act on it. Reduce size, step away, take a break. Discipline without accountability is just theory. He also stresses slowing down your decisions. Cognitive biases love speed. The faster you act, the more likely you are to fall into autopilot. Confirmation bias, loss aversion, anchoring. So force friction, pause, reread the plan, delay entries. Reflection creates space, and space invites reason. Another powerful tool? Position sizing. Most traders blow up not because they're wrong, but because they're oversized. Montier ties this back to ego. You size up when you feel certain, but certainty is just emotional inflation. If you size based on confidence, your equity curve will mirror your mood. But if you size based on risk parameters, you become immune to emotion. And here's where Montier gets brutally clear. You will never eliminate your biases. They are part of your operating system. But you can build guardrails. You can reduce their influence. You can create systems that compensate for your weaknesses. That's not weakness, it's wisdom. He also suggests a radical but powerful practice. Take trades you don't love, but that fit your plan. This retrains your brain to trust the process over feelings. When you win on a trade that didn't feel right, you internalize a new truth. You don't need conviction, you need consistency. Lastly, Montier leaves you with a principle: invert everything. Want to be a successful trader? Start by avoiding all the mistakes most traders make. Want better performance? Spend more time reducing errors than chasing perfection. Inverting helps you see what you've missed. This isn't glamorous. It won't go viral. But it works, because your mind will sabotage you unless you build a system that stops it. You can't trust your emotions. You can't trust your memory. You can't trust your impulses, but you can trust a process. And that's what this book and this journey is all about. The market isn't just a game of charts and numbers. It's a game of you versus yourself. And James Montier's message is crystal clear. If you don't understand your own psychology, the market will use it against you every time. You've walked through the minefield: overconfidence, loss aversion, herding, overtrading, forecasting addiction, narrative traps, guru worship, and fear of uncertainty. Each bias is subtle, invisible, but together they build the very behaviors that sabotage your edge. Montier doesn't just diagnose, he arms you. With journals, with checklists, with pre-mortems and process design. He doesn't promise certainty, he promises clarity. The kind that comes from self-awareness, structure, and daily discipline. The truth? Trading isn't about knowing what comes next. It's about staying grounded when you don't. So what now? Start simple. Journal your next 5 trades. Build a pre-trade checklist. Set a rule and follow it, no matter what. Don't wait to feel ready. Act your way into control. And if this video helped you confront your patterns, then share it with someone still stuck in theirs. Like, comment, and subscribe for deeper dives into trading psychology. Turn on notifications to never miss your next mindset breakthrough. Let's trade the market without trading ourselves. Project complete. Let me know if you'd like help with a YouTube title, SEO caption, or video storyboard.